Greetings, everyone. Today is Monday, March the 10th. This is the Daily Scan with Dan Bird, coming to you from breakpointtrading.net. Big sell-off today. Was down more than 1,000 points at one point. Certainly wasn't the rebound that I thought might happen last week. So we'll see. Maybe it's delayed. We shall see. Lots to look at today, and a lot of symbols that people have asked me about too. So we've got a lot to cover. So let's first start off with, of course, the disclaimer. I'm not a financial advisor. Anything I say is for educational purposes only, and you need to understand your own trading style. Past performance does not guarantee future results. And I thought I would use this little image that I actually created a long time ago. I actually created it for another channel that I do. A lot of you know Mike Zuber on One Rental at a Time. I highly recommend for anyone that's interested in real estate to check him out. He does quite a few YouTube shows. I do one with him on Sundays. Usually he is currently on vacation, so I did one solo last week, but One Rental at a Time. Look up his YouTube channel. Very great content over there. Good stuff about the economy as well. But I created this when I first started with him, and basically the reason I show it today is because I've been hearing from some people that folks are still bullish. And I'm going to show you some charts here that shows that as well. But there are people that are saying, time to get in, time to jump into the market, because now the selling is just about over and it's time to load up the boat. Well, that's what's called BTFD. So it's not a Ponzi scheme. It's a BTFD scheme. And BTFD stands for buy the frickin' dip. So here we are going up, buy the dip. Everybody's happy, buy the dip, buy the dip, buy the dip. Everything's going great. And then it comes down like we're doing right now. And people are still saying buy the dip, hoping it's going to go back up. And sometimes it does, and then comes back down again. And everyone keeps saying buy the dip. But at some point, buying the dip just makes you sad. You end up crying and lose all your money. So you have to understand the difference between buying the dip and a falling knife. And right now, everything sure looks like a falling knife. So let's go over and take a look at it. First, this is my website, breakpointtrading.net. You can find the YouTube channel here as well, along with lots of other things, a free newsletter in this box right here. And I'll show you some of this in a second, but let's go to the home page. And what you'll see is the market bias chart went down slightly again today. Now you might be saying, look up here, this changed to all bear. It's got a red light. We shouldn't be doing anything. Why is this market bias not going down a lot more than that? Well, the first thing I would point out is that it started going down tremendously way back here, and that was giving you the early signals that it was time to move aside. So this was way back here around February 21st to 24th, somewhere in that week. That's when I gave a bear signal as well. So that's really the key. But in order for it to go down, there has to be a lot of bearish signals. And the way it's structured is it looks at the indexes, the sectors, industry groups, relative charts, commodities, metals, and currencies, and each one of them on a short-term, medium-term, or long-term basis. And whenever the short-term flips over from bull to bear, and you can see the definition of it right up here, then it turns red. And look at in the short-term column how many of these are red, almost all of them. So you can't get another red if it's already red. So the only thing that can happen next is the medium term starts to turn red. And you can see that they have started turning as well. And you can actually see the colors here on this week, day over day, week over week matrix. You can see that they started turning red way back here. There's 221, 224 is right there. So right here, the medium term started turning red as well. And then the last one to change is the long term, which has still got a combination of greens, yellows, and reds. But if you look at the slope of the charts over here, the short term started going down right here. And even as the medium term continued to go up, and then the medium term went up, the short term went up a little bit, and then it started crashing right through here. Well, the medium term followed But in order to get more of a downside on the overall number up here, the medium term has to go down a lot more now too. So I'll show you what it looks like very quickly. So there's the medium term that's crossed right there. And you can see it's crossed in quite a few cases, but not all. So it's already crossed. So a lot of those are already red. So in order to get more of those, so here's one right here. This is the New York Stock Exchange. That has not crossed yet. 2 more days, and that'll give a down signal. But most of them, here's one that hasn't. Here's the value. 2 more days, that'll probably cross over. This one down here, utilities, has not crossed. Sectors, so communications hasn't crossed over yet. So a lot of these still need to cross the medium term in order for the overall market to go down even more. So that's how that works. So let's go look at the dashboard real quick. So here's equities. As you know, down 890 at the close, but it was down over 1,000 intraday. And you can see it bounced back here right about 3 o'clock. It started coming back up. So don't know if that means it'll continue to go up tomorrow. It's really, really oversold. So it's going to get a bounce here soon. But look at the VIX. The VIX at pretty much 28 made it up to 29.5. When the VIX gets over 30, the selling can accelerate very, very quickly. So, and even now, and I've been warning everyone, over 20 is when bears are in control, and bears obviously are in control right now. And it accelerated today, but is that enough for the bottom? Well, I'm going to look at that in a second. 20-year bonds actually went up, did pretty well today. Commodities, gold went down. Gold went down a little bit. Gasoline went down. That'll all be good for commodities or for the CPI next week. And crypto, Bitcoin, of course, closed at 80,000, but it was down to about 78 earlier in the day. So Bitcoin was down as well. Let's take a look at the sectors. Look at this. All the declining stocks in each of these sectors, clearly way more decliners than advancers. We're going to see what effect that has had here in a minute. But you can see the bottom 3, technology, discretionary, communication services, are all aggressive sectors. And they're down considerably. The ones at the top are all defensive sectors. So clearly rotation out of aggressive and into defensive. Wall Street has been doing this for a few months, and I've been talking about it for quite a while. Wall Street's been making that rotation. They like to do it when retail traders are still buying so that they have somebody to sell to. But here very soon, and probably started today, the market makers are just stepping aside now and just letting it fall. So get a big, huge down day when that happens. Next week is earnings, or rather options expiration. And we're going to have the Max Payne, which I will cover probably on Monday if I have the report. But I expect Max Payne next week to be up because it's usually opposite of what the market does. Unless we get a rally this week, which is possible too. So you can see the top industry groups are all defensive except for mobile telecom was the only aggressive group in all of those. And these are my top 10 combined lists that I update every week. These are stocks that have made the top 10 in a number of different categories. But take a look at the bottom. That's the more interesting ones. So these are the ones that they actually had been in the top 10 before. Gorilla Technology had a really nice run. Robinhood had a great run, continuing to sell off. We go one more back. SoundHound had a great run and it's continuing to sell off. AST Mobile actually doesn't look too bad, just going sideways. Interactive Brokers sold off big time today, down 13% today. One more back. CRNC selling off. Palantir, big decline in Palantir from 120 down to 80, below 80, down 10% today. So down to 76. It was at about 126. So that's about a 30% decline in just about 3 weeks. So a lot of these are selling off and maybe setting up for a good entry point if the market ever turns around. We're going to see how to figure that out. Here's Bros. This is one that a symbol that somebody asked about. There you can see what the chart looks like, but we'll look at the chart again here in a minute. Okay, so next I want to take a look at the market itself. So on the website, on the charts page, there's something that I just updated here under business cycles and sectors. So it's on the charts page for those that are subscribers. A little button down here, business cycles and sectors. We click on that and we see these are updated at the end of each week. So these, you can see the aggressive sectors on the left clearly rolling over and the defensive sectors are starting to move higher. So that's a clear visual of rotation right there. But what I want to talk about is this one down here, sector rotation model, and really the market versus the economy. And this is a really important concept to understand because you can't go by what the economy is doing if you're in the stock market. The economy follows the market. The market leads. So if you're starting to hear news on CNBC or any of the talking heads, or especially mainstream media, that we're heading for a recession or we're in a recession, well, it's already too late for the market. The market has already priced that in and is already probably starting to move higher as the economy goes into a full recession. When we're at a market top, like we have been in the market is the red, the economy is in the blue. So when we're at a market top, the economy is still recovering and still moving higher, or everyone thinks that it is. So when the market starts to roll over like we're doing right now, and we're probably somewhere, probably in this area right here, just before moving into a full-fledged bear market. So I'd say we're probably right in here. The economy is still actually looking pretty good. And the Fed will say the economy looks good. The jobs numbers came in not too bad. We're going to get a CPI next week. That probably will be fairly tame. So the economy still looks good, but the market's rolling over. The market knows ahead of time and will take positions ahead of time before the economy. So it's better to watch the market than it is to watch the economy. So once the market gets down into bear market territory, then we start falling into early recession. The market will then go to the bottom, late bear market, and I'm going to show you how to identify those and show you what that looks like right now, while the economy is still going through a recession. And the economy goes through the recession even as the market comes out of the bottom. So you really have to understand this idea, because if you listen to the news, then you're always going to be behind. You have to anticipate what's going to happen if you're in the stock market. All right, let's go take a look at our bottom finder chart. And I'm going to use the NASDAQ 100 for this. I've actually added the 20-day on here as well. So here's the NASDAQ 100. You can see clearly it's broken down, went below the 50, the 21, went below the 200. So below all the moving averages right now. The 50 is starting to roll over. But take a look at what's happening here for the things that we want to look for a bottom. Percentage of stocks that are above their 20-day moving average. Today was 24%, or 24 out of 100 stocks were above their 20-day. But when we hit a bottom, that number should be below 10%. There should be fewer than 10 stocks that are still above their 20-day moving average. That's not happening yet. Even with all of the selling, we're not there. Percentage of stocks above the 50-day. Right now, it's at 35%, or 35 out of 100 above their 50-day. But usually during a bottom, like we had back here last April, and it looks like we're heading into something similar, although actually it's even a steeper sell-off than we had last April, but we had a similar thing that happened in April that we're doing right now in March. But we get to the bottom right here, and the number of stocks below the 50-day or above the 50-day was at below 20%. I think we hit like 18 or 19% back here. Those are the two things I'm looking for. I want to see those two things happen. I want to see the 20% above the 20 go below 10%. And I want to see the percent above the 50, above the 50 go below 20%. None of those are there yet. So that implies we still have more downside left. And then, of course, the 200 is also one to watch, but the 200 more gives you a sense for the longer term trend. And what this is telling me, it just went below 50. It's at 48% now. Number of percentage of stocks above their 200, but you notice that it went down much further than it did back here for this bottom. So that means the rally that we've had ever since here, the rally here recently, is actually weaker than the rally was back here before April, because there were a lot more stocks above the 200-day back during this period than there are right now. The other thing to look at is the VIX. The VIX right now is at 27.86, almost 28. If the VIX hits 30, then the bottom's going to probably drop out and the downside will accelerate. We'll see if that happens soon. I think it might happen at some point. What I'd like to see is capitulation, and I'm not seeing capitulation. Even though the VIX is elevated, it's in bear market territory, hasn't gone above 30, and all of these things here are telling us that there really needs to be more selling to get to capitulation. So back here during this period, the VIX actually just barely got up to 20 during this period. And it spiked considerably here, but came right back down again. But didn't stay there for very long. This time the VIX is staying up there. So that is concerning. And then finally, the put-call ratio. And this is the one that is telling me that we are not there yet. We are not at a bottom. It's not time to buy the frickin' dip. Not time to try to grab a falling knife, because the put-call ratio, if it's moving up, that means more puts are being bought. If it's moving down, that means more calls are being bought. Right now, it's kind of in the middle. When it gets to significantly oversold, like down in this area, that's typically where tops are put in, but it's not a really good indicator for tops. It's a much better indicator for bottoms. So if you look over here, 3 times it went above the 72% area, and you can just follow the VIX, see where the VIX spiked up right there. This time it didn't really get up there. And you'll notice this time right here, there really wasn't much movement in the market itself. But in this case, it made it above the 72 these 3 times. This one here marked this bottom. This one here marked this bottom. And this one here marked this bottom. And we are not there yet. In fact, we are a long way from there. And not only that, even as we've had all this selling, the put-call ratio is actually moving down, which is implying that people are buying calls. People are BTFD, buying the frickin' dip. Even as the market moves down right here, people are trying to still identify where the bottom is, and they're buying calls. I need to see that way up here around 72% or better or higher. So those are the things that I'm looking for to identify that it's over, that there's a bottom in, and I'm not seeing those yet. Now, we certainly could get a short-term rally. That could happen at any time. And we'll see if it's this week or next week. All right. Let me take a sip here real quick. By the way, I have a new microphone, so let me know if you think it's helping at all. Okay, next, there's the bottom finder. Let me show you something that I added to the website that is interesting. Very interesting idea. This is with Bitcoin. So I have a Bitcoin section right over here, and I added this Bitcoin versus gold. And these are ETFs. So this is, on the top is IAUM. So that's a gold trust ETF, micro ETF. And below it is IBIT, which is a Bitcoin ETF. And I put a correlation underneath that. So you can see if it's in green, then they are correlated, which means they move in the same direction. If it's in red down here, they're uncorrelated, or they move opposite each other. So the way to read this is down here is the relative. I don't have a price. I just have moving averages down here. This is the relative of gold to Bitcoin. So if it's moving down, then Bitcoin is outperforming gold. If it is moving up, then gold is outperforming Bitcoin. And where the moving averages cross is potentially a time to switch your positions from Bitcoin to gold or from gold to Bitcoin. So you can see here, watching the Bitcoin ETF moving averages here, there's an opportunity right there, at the same time that Bitcoin starts outperforming gold and these moving averages crossed over, you could jump into IBIT. Now, you would certainly also be in gold during this period. And then the signal to get out of gold was right here when the 5 crossed the 21. And potentially you could have started thinking about it back here when Bitcoin started outperforming gold, but that's confirmation. So you get out of the gold position, then back over here, and moving averages move back across again. And you could get back into gold even at the same time you were still in the Bitcoin ETF, and then get out of the Bitcoin ETF when gold starts outperforming Bitcoin again, right here. So you can see what Bitcoin has done since then, and you can see what gold has done since then. Gold right now is just kind of going sideways. So they probably will, they are highly correlated right now because they're both going sideways. Although this is probably going to move down because Bitcoin looks like it's going to drop faster than gold is. But this is just a way to just play gold and Bitcoin together. Just watching this chart, you can switch back and forth between these two ETFs and play those two trends. All right, so let's take a look at a few symbols that people ask me about. Let's go here. I'm going to start with Powell. Powell is one that a subscriber asked me to take a look at, and in particular, to talk about it's got a very wide ATR. The ATR is, in fact, if I look at it on this chart right here, and look at Powell, I have the ATR on the chart. You can see the ATR is 1365. It's almost 14. That's the average true range. And the question was, how do you set stops when you have an average true range that moves so much? Well, the average true range tells you the average that it moves in one day. In this case, is the daily chart. So in one day, it moves about 14, could move about $14. But more importantly, the first thing I would look at, and I don't know when this person got into this. I don't know if they're in now or if they're thinking about getting in or whatever. So I'm just going to talk about this in a general sense of looking at the chart. So Powell is one that was on our top 10 list back through this period right here, right where the 5 crossed the 21 right there, and the MACD crossed up here would have been my warning sign that might be time to take profits and get out right here. When it went below 0, it confirmed the downtrend. So that's the second opportunity. When the 21 went below the 50 and the MACD was already below the 0, that's your third opportunity to get out. And then it made a comeback. So all these things went back up again, but it didn't last very long and started rolling over again. So you could have been whipsawed in through this period unless you would just notice that the 21 was still below the 50. So just stay out until that gets back above, which it never did, by the way, never did get back above the 50. And then the MACD continued to go lower, went back below 0. Now it's perhaps turning up, and you can see the price is flattening out down here. So I'm going to move back add a year to the 7 months and then put in a support line right about here. And you can see it's sitting right on support. It looks like it's trying to curve back up. So if I were looking at this right now and trying to decide where to put a stop, it depends on what your goals are. You might be fine hanging on to this. It does have a dividend yield, but not much of one, 0.67 dividend yield. And earnings have already passed. So earnings were last week, or last month rather. Won't come up again until May. So that's what it looks like. That's where the support is, sitting right on support. So for me, what I would do is put a stop just below that support line. So in this case, it would be right down here, probably at 140. If you wanted to hang on to it, want to give it plenty of room, probably about 140, 145. But in general, question was, how do you set a stop when you have an ATR that could be that big, 14 points? Well, that implies it could move 14 points in one day, but then the next day it could move another 14 points, and the next day it could move another 14 points. So it's more important to identify the trend, because that 14 points could be a negative 14 points every single day. That doesn't mean it goes down 14 and then up 14. It could be down 14 every single day. So it's more important to identify the trend and figure out where to get in based on the trend and where to get out based on the trend. Right now, it could be forming a bottom, but it has not had a character change yet. Character change would be a higher low. It needs to be above this point right here, at least, I would think. So that's about 185 before there, and then come down and make a higher low. So it needs to make a low that's higher than this, probably up about 170 before there's a character change. This could just be a pause before a continued downtrend. It is, to its credit, hung in there pretty well on a really bad down day today. So that's my opinion on Powell. SVIX, I'm going to go through these pretty quickly. SVIX is the short VIX. You saw the VIX was going higher. We saw that on this chart right here. I know I had mentioned in the past that when the VIX spikes, now in this case, the VIX spiked all the way up to 45 or 50 up here. When it spikes like that, it comes down very quickly. So SVIX would be a good play for a very quick profit. But when the VIX is moving up as slowly as this and just slowly climbing higher, then it could just continue to go higher, and it could just hang out at a high point for quite a while. So you have to understand that as well. So for the SVIX, I would stay away from it right now, for sure, until we get a bottom. And you can use that bottom finder to identify where the bottom might be. Okay, let's look at Bros. I mentioned this before. So this is one somebody asked. Bros is just heading straight down. That is a falling knife if I've ever seen one. So there's the definition of a falling knife. How far will it fall? Well, let's see so it's almost in the 3x extreme. So it probably is going to get a bounce at some point soon, but I doubt if it gets back above 70 once it does. So if you're looking for a place to get out, then probably 70 might be a good spot. 70 is right up here where the 21-day is. That's probably what's going to happen. I think that'll happen with the whole market. A lot of these may bounce to the 21 and get rejected and head back down. Just like the 21 is reversion to the mean when stocks are going up, and we get used to it coming back to the 21 and bouncing and continuing to go higher. The exact same thing happens when stocks go down. They break through, they hit the 21, they hit the 21, hit the 21, and go down. And in this case, it hit the 50, went down, and now 21 and 50 are crossing. So now it's starting to tell you that this is a character change right here. So there's a lower high, lower low, and lower high. Here's a lower low and a higher low, lower high and a higher high. That's a character change right there. So that's when you should start looking for other things like the moving averages and things like that. Or if you use trend lines, then you might want to look at a trend line break like this to get in. So the trend line break was right there, right at pretty much the same place as the moving averages crossed. And big up day with good volume. So that was the break of the trend line. That was the move higher. But right now, it's the opposite. So everything's breaking down. I can't tell you where. I think the best way is just to look at the Keltner channels, and probably somewhere around 55 might get a bounce, as well as the rest of the market. But right now, not looking too good. Kava, another one that had been doing really well, and now was looking like a falling knife. It's looking like it's starting to curve a little bit, and didn't do too bad on a big down day today. So this one might be forming a bottom here as well. If I look at this on a longer term basis, and I could see probably a bottom right in this area. So that's right where it's at, or at least that's where support is. Could break through support. Look at all the volume on the down days. So Wall Street was definitely getting out of this one. So that one, again, that's a falling knife. I wouldn't call that a buy the dip yet. I would wait for confirmation, wait for a character change. Needs to make a higher high and a higher low before I jump into that one. All right, what else? SWK. That's a sloppy chart, but actually hung in there fairly well today. Looks like the 200-day is clear resistance. So it keeps about every time it gets to the 200, it gets rejected. It is making a higher low though, higher high, a higher low. It is making higher lows. It's not yet making higher highs. So you'd like to see that. This is Black and Decker. This is in the industrial space. So this is where Wall Street might rotate to. The rest of the market's falling apart. So it might actually be a good one if you're diversified, but it really needs to get above that 200-day. And the market, I don't think is going to cooperate with it. Wolf also just continuing to go lower, might be putting in a bottom here, but it's not a higher low. It's actually just equal. Could be a double bottom or even a triple bottom. But it needs to prove itself. It needs to get back above this high right here. So it needs to get probably back up to 8 before I would feel confident. It's in semiconductors. By the way, tomorrow on Technical Tuesday, I'm going to talk about the new Dow theory. Semiconductors plays a big role in that. So if you're looking at semiconductors or are in these, I would highly recommend tuning in tomorrow for that session. All of them don't look too good. NVIDIA is not one that somebody asked about, but I'm just curious. That's a falling knife for sure. Another one was IBM. IBM actually looks really good. Even with a big sell-off today, it hit resistance right up here, but it's sitting right in a channel right through here, right in that channel. So it could bounce along inside that channel for a little while, but it actually held up pretty well today, considering what the market did. So IBM actually looks okay. Earnings are on April 23rd, 2.6% yield on the dividend. So if you're looking for dividend, that's over 2%. This one actually was on my dividend list for those that saw that. So IBM actually is probably the better one of all of them today. ELF. ELF was definitely a falling knife. It looks like ELF is making a comeback. Earnings were last month. Let me go back a little bit further. Go back 3 years and see what it looks like. So there's an open gap right in here. That's where probably I would put support right in this area right here. So just about where it is right now. And then the top of the gap is there, which is right where it hit. So that's pretty much where support is right now on that one. It looks like it's recovering, so might be good news. So bounced off of that one. Again, this gap right here looks like it was earnings. So earnings didn't look like it came in too well. It's got a lot of work to do to make up. It's got a lot of overhead resistance. It's going to run into sellers all through this area. All these people just want to get out at break even. All the way back up here, probably will get rejected at the 50-day when it gets there, depending on what the rest of the market does. But in the short term, it could have a little bit of a rally up there. But I would be careful on this one. If you're in it, especially from a higher level, then it's probably too late to sell right now. Just hang on. But even with the bounce right there, I would not be taking a new position personally in ELF. Okay, one last one. It's Apple. And somebody said, look for the head and shoulders on Apple. So kind of a sloppy head and shoulders, but there it looks like there is one. Let's call this the left shoulder, call this the right shoulder, and there's the head. And the neckline would be right about here. The neckline right there. And what that means is that's 220. And this one up here is at about 260. So that's 40 points. So the target, potential target is 180 right down here. It's right at the top of that gap back here. So if this turns out to be a head and shoulders and you don't know, I did a whole section on patterns on Technical Tuesday, so you can go back and watch that. But if this turns out to be a head and shoulders and you don't know until it breaks through this support area right here at 220, then potentially the target will be 180. And it won't be immediately, and it won't be directly down, and it won't be straight. It'll be jagged all the way down, much like that. Actually, let me show you because it's relevant in this case. Much like the market process. Not that one, that one. So much like this. So, we're right here right now. We could bounce back up. Probably at this point, we'd probably bounce back up to the 58.50 level and then head lower. You can see how steep the 21-day is coming down. So that's where I think it's going to probably get rejected. If we do get a rally, probably around the 21, it'll get rejected. But this looks very similar to Apple with that head and shoulders. That's what Apple will do. It'll come down jagged like this as it goes lower. There was one, yeah, this is one that I wanted to show. This is an important one to keep in mind as well, especially for retail traders. This is the psychology of the market. So you got hope that it's going higher, optimism, belief. Yeah, I was correct. It is going higher. Thrill. Everybody's talking about it. Everyone's giving you stock recommendations. What did I tell you? It's all the way at the top. And then you get euphoria. And I don't think we've had euphoria yet. So I don't think we have made it to this level, although we could actually just skip it because I think we are in complacency, or we had been in complacency up until last week and today especially. So the selling was just profit taking. The sellers will regret it later. Then anxiety. So this might be what's happening right now. Shouldn't have margined. Then we get denial. It's a good company. PE is great. How do I hide this from my wife? And this is for fundamentalists. Of course, if they believe in the company and everything the company is doing, then you can hang on through all of this, even through the capitulation phase. And that's the real test. When it is so painful that you've lost all this money back here, but you still believe in the company because of the fundamentals, you have to hang on through all of this phase or even buy more. So then panic and then capitulation, that's what I like to look for a market bottom. Market is rigged, never doing this again. Who can I sue? It's not my fault. Depression, can't believe my boat got repoed. And then finally we get back to the disbelief phase, just like we did back here, and markets will do it all over again. Oh, sure, this won't last. Just like back here. Last few rallies failed, this one probably will too. So that is very much like, it's a psychological mirror to this, to the technical process that markets always make. So this is the psychological part of it. So you want to get out during the euphoria phase, like Warren Buffett does, and moves everything to cash, and then wait for the capitulation phase down here to start nibbling and taking positions, waiting for this next phase right here, which will come, will always come. All right. So yeah, I did want to cover that one. Um, anyway, I think that's everything I had for today. Hope everyone is safe. I hope that the market does rally. If those are still in, might give you an opportunity to get out without too much damage. Um, and markets do rally. They will rally in a bear market. So we'll see what happens. Um, by the way, if we look at the 10-minute charts right here, you can see the little rally at the end, 3 o'clock, started coming back. But we are still below the trend line. So this trend line is still telling us that it's not yet time. It's going to have to get all the way back up here to 57.25 and break through that trend before it's confirming that it's back on an uptrend. But this might be the start of something, but who knows? We'll see tomorrow. The other thing, notice all the aggressive sectors, they're all lower, except for communication services did well, and industrials did pretty well. But if you look at the defensive sectors, they are all going up. Healthcare, staples, energy, utilities, materials, all of the defensive ones are moving higher. That is rotation. So be careful out there. We'll see what happens tomorrow. Tomorrow is Technical Tuesday. I am going to cover the new Dow theory, which is right here on the homepage. So we'll talk about this and I'll explain what it means. And for those that are subscribers, you'll be able to see the charts for the new Dow theory, and you'll at least know the next time we get ready, next time we start making all-time highs, you'll be able to tell whether it's going to stick or not. So stay tuned tomorrow. Thanks, everyone. Please like and subscribe. Go check out One Rental at a Time with Mike Zuber if you're into real estate. Great channel for real estate. And I also do a show over there so you can cross-reference stocks with real estate if you are so inclined. And that's it for today. Thanks for watching, and I will talk to you tomorrow. Take care.